as they come in. We're following up on this is the part two. And in case we need to have a part three, depending on your questions, we'll have a part three. And then based on the interaction that we will have during the retreat with all of you, or with most of you, in a month down the road in Mombasa, we will then decide what are the key gaps that we have that need to be addressed through these training programs. And these could be related to sales and marketing strategy. These could be related to alignment in terms of building a new culture. These could be related to other matters that we will see will be important. So spending 3 full days together will give us a chance to understand your needs and to see how best to respond to those needs. So we're here to address it, and hopefully you will find this session interactive. Now, always also feel free to give feedback to maybe we'll appoint Shaheen, who is on the call. I don't know if you have somebody else in mind, or Catherine, to see what sort of other training needs you and your team would have, and any feedback that you have on the way we are delivering those trainings. We try to keep them short and sweet, about an hour and a half. And then if you have, and we try to have case studies around each one of them, so that to put some perspective to it. So feel free to reach out. So, Shital, who should be the right person for them to reach out to Catherine or to Shaheen?
I think Shaheen would be great.
Very good. And since I'm already loading Shaheen, I'm continuing to load her. I could see her smiling face. I don't see her smiling face, but I could imagine her smiling face. And since I entered her life, I'm keeping her busy every single morning. So this is great. Thank you, Shaheen. Very good. So let's start. This is the part two. So Lama and myself will be delivering. I'll start the first couple of section of it, and then Lama will take over on building the financial models. Lama, can you next slide, please? Okay, so this is what we have covered already during the past session. So we went quickly through why is financial management important. A number of you, of course, are in the finance team, but the message behind it is all of you need to be able to speak this language. And there is no way you can grow in whatever position you are and whatever business you'll be without understanding this language, and without understanding why is this language important and how it's helping us shape the destiny of your organization or your project that you want to go through. So this is the why for financials. We went through the 3 financial statements, the income statements, which looks at the situation typically on a quarterly basis. This is looking at your revenue, looking at related expenses, and looking at your profit margins. The balance sheet, which is a snapshot at one point in time, typically at the end of the year, of what are the situation in terms of assets and also the liabilities. And the difference between the assets and the liabilities is what we call shareholder equity. And this shareholder equity is actually the net book value of the organization. So this is one first attempt to define value for an organization from an accounting perspective, is by deducting assets from liabilities. And then, of course, this is the most conservative portion because it doesn't take into consideration future revenue stream and future cash flows that will be generated. It also doesn't take into consideration the actual value of those assets, but it looks at the historical value. And lastly, it doesn't take into consideration the IP. And in your case, in most of your case, it's really the brand. You've built the brand, you're strong with your brand, and the brand has value. And this also will be incorporated in the valuation of the organization. organization. So this is why you will always have the actual value of an organization systematically being higher than the net book value that we will see from the balance sheet. Then the last one is the cash flow, and the cash flow forecast is probably the less understood and the less used, but probably the most important of those financial statements, because it gives you an understanding of where is cash coming in and where is cash going out. And not only today, ideally we'd look at this over the next 3 or 6 months. And cash flow forecasting is really at the essence of managing a good business, because you need to be on top of the cash that is coming in and the cash is going out. And we have shared with you examples, and we'll share some more examples today. So then we will move to cash flow management. Basically, how do you manage cash flow? And a number of organizations today, being it in Kenya or being it in Lebanon or across the region, every single one of them have cash flow issues. So how do we do about managing this cash flow? Understanding your cash flow gap that you will have not only today, but in 3 or 6 months down the road. How big is this gap? When is this gap happening? And what are the ways to be able to address the gap? And the typical ways we went through, we look at your working capital. What can we do on your receivable or inventory for those of you who carry inventory? What can we do from the OPEX structure? And what could we do from a CapEx or other means that we have in order to optimize the cash flow? And in case we still have gaps, what are the means to bridge this gap? Being it shareholder injecting in this organization, being it new shareholders coming into the organization, being it debt funding or other means of funding. So this is what we have gone through in terms of cash flow management. We looked at a typical budget. And we discussed the case of Joysam. Joysam is one of the Stanford seed company that I've been working with closely for the past 10 years. And the CEO has fully behind us developing this case study. So to show an example of how a budget look like and what is the role that you will have in terms of board to be able to approve the budget, and if you don't approve the budget, what should be the conditions that you need to have in place so that this budget is quality matters that you will approve. And this is an important responsibility. Again, whether you're for-profit, non-profit, whether you are small, whether you scale up, whether you're a multinational, whether you are a department, each one of you will have a budget. And we will be preparing the budget when we get together in Mombasa for first pass of the budget. And this is what the finance people will have to submit for what is the exit going to be for 2024 or your forecast for 2024, and what will be your preliminary budget for 2025. So this is important, and this budget, of course, cascades down the organization. So this is important. We didn't cover Alliance financials. I might have it when we are together, because this is very specific to your industry. We might include it in the training that we will be one of the trainings that will be taking place in a month down the road in Mombasa. Now, today, what we're going to do is we're going to focus on financial ratios. Why are those important? And when you look at the financial ratio, we're going to show you a case study, again, of an existing company with whom we have been working for the past 4 years. And what can we draw? You won't see neither income statement, you will not see a balance sheet, you will not see their cash flow statement, but you will see their ratios over a period of 5 years. And this is, and will govern why are financial ratios important. What do you do with financial ratios on it? And then we will show one of the application of financial ratio, which is basically balance scorecard. The balance scorecard, a number of you, of course, are familiar with it. I'm going through quickly because you have been not only exposed to it, this is what you have been sharing with us on it, but to show you the link between the ratio analysis and between the balance scorecard, so as to have a much better understanding of the financial situation of the company, a transparency in terms of what is working and what not working, and most importantly, it's a sense of accountability, because ultimately the CEO of an organization, so if I look at Shital or I look at other CEOs that are present today, please mute Lama. Joanna always mutes everyone on the call. Lama, can we please mute? Thank you. So can we systematically mute? This will be great. Thank you.
Sorry, Constantin, I have to mute all, but then you have to unmute yourself.
Yeah, no problem. Mute all, and then I'll unmute myself, so it's no problem. This is on the balance scorecard. We then will move to a typical performance review. So what we would look at, if I'm a shareholder or I'm sitting on the board, what we expect the organization to be showing on a quarterly basis. This is where we stand from a balance scorecard, but this is also what worked and what did not work in the organization. And lastly, we have Lama, who will share with you. This is one of the elements that are important. Now, with Shital and with Ali, we actually have done a summary of the 5-year financial forecast for the organization, for EHS, MIC Global, and we will be sharing those with the team when we are in Mombasa. So this financial forecast is important because any investor who wants to get into this organization need to understand not only where you stand today and where you stand over the past 2 to 3 years, but also how is the future looking like? Where are these growth opportunities that will be coming in? How much does it cost? How much do we need to invest in order to activate these growth opportunities? And this is built on the 5-year financial forecast. So this is important. And it's a fundamental element. Every single company that we work with, we help them develop their balanced scorecard. We help them develop their story. We call it their investment pitch, but we also help them develop their financial forecast so that they are in a position to be able to meet and to face potential investors. On another program that we're working, and a few of you on the call today are part of this program, we have been working with you for the past months in order to prepare you for September 3rd. September 3rd, you'll be pitching, and part of your pitch is your investment pitch, but the other part of the pitch to support it is your financial model. So we've been sitting down with every one of you to review your pitch, to review your financial model, and to give you feedback in terms of how this needs to be adapted to reflect reality and to reflect our own experience that we had working and funding organization over the past years. Okay, so this is the agenda for today. If we cannot cover it all, it doesn't matter. We'll have another sessions. We have these sessions on a monthly basis. I always encourage you, and Lama puts the link for those who don't have it to access, because you'll have the date, you'll have the timing of the next event, and you'll have also the link for the next event. So financial ratio. The next slide, please, Lama. Okay, why are financial ratios important? Now, I've hinted to it. I think most importantly is we need to look at your performance, financial performance over a period of time. So not looking at 1 year and the previous year, we need to look at it over several years. So this is important. Why? Because it gives us an idea about how you are developing on different level, on growth, on profitability, on how efficient you are with your working capital, on how leveraged you are, and other means. So it gives you an idea about how we looking back. But what it does also, it gives you, ideally what you have is for your own specific industry or your own specific sector, it gives you benchmark. So the benchmark will say, for these companies in this sector, this is what the profitability should be in terms of gross profit or operating profit. With one of the companies that is present today, CCHO, we are doing this exercise and we're benchmarking what are the profits of other competing companies in this sector across different geographies, so as to see where we stand on this. Are we growing fast enough? Are we profitable versus others or not? So it's an internal view looking back. It's also an external view of what is happening in the industry. So this is what it does also. It gives you idea about what is working and what is not working. And you will see, for instance, in this specific case, where are the gaps? What are the challenges that the organization is facing? And if you put those financial ratios, and it's up to you, it's up to Shital, it's up to Ali, it's up to Raj and the finance community to decide what are the financial ratios that are most relevant, because these financial ratios might not be relevant, for instance, if you're into the consulting business and you carry no inventory. So your DIO or your inventory has absolutely no meaning. So it's up to you as a team, and we will help you in the process to decide what are the ratios that are the most logical and the most applicable for you. So this is important exercise that we need to do. It's also important for us, once we know what the gaps are, what are the actions that we need to take place? What are those actions? And this is what we discuss. We discuss at board levels, these are the gaps, and this is the way to mitigate these gaps moving forward to it. Okay, so this is, and then of course it helps investors. The first thing, if I'm going to invest in one of the company, I want to see the historical. I want to see what's happened, and I want to see, and then what I do from those financial statements, if you don't have this ratio analysis, I will develop the ratio analysis to see what is working and what is not working in the organization. Okay, so this complements your financial forecasting, which is moving forward. Next slide, please, Lama. Okay, so what are the financial ratios? 5 categories to keep it simple. One is profitability. How profitable is this organization? Number 2 is efficiency. So how good are you in managing these assets? Primarily zooming in on working capital, which is a combination of your receivables and of your inventory. And the more efficient you are, the more value you have. The more profitable you are and the faster growth you have, the more value you have as an organization. So these are value drivers. These are the drivers that helps you create value to the shareholders and also to the community. The third one is liquidity. How good are you? How liquid are you to honor your short-term liabilities? And a few of the companies, not EHS, not MIC, you've been extremely profitable, and I've hinted this a number of times when we had our quarterly review, but many other organizations today are going through liquidity crunches, and they have liquidity problems, and we need to understand how severe are these liquidity problems, and these ratios help us understand it. The fourth one are gearing, leverage. Some of you are leveraged, others are not leveraged. Some of you are leveraged to the maximum. Others have zero leverage. So leverage actually is good, what you do. So it's the cheapest way to get funding, beside grant, of course, is leverage. So how leveraged are you? How much leverage can your organization take? And how to manage this leverage so that it doesn't affect your cash flow. If you're too leveraged and interest rates are going higher, then you will have a big issue in terms of payments of interest expenses that are getting higher, and this will affect your cash flow forecast. And lastly is your investments. We as shareholders have invested in this organization. We need to understand from a couple of ratios how good has this return on the invested capital been. So these are the typical 5 ratios that you will find. I'm sorry, getting out of COVID and it's taking some time. So my sinus are stuffed and my my voice is my throat is a bit. So bear with me for today. Next slide, please, Lama. So these are the ratios. I'm not going to go through it. You've been exposed. So these are all coming from either the income statement, or they're coming from the balance sheet, or they're coming from the cash flow statement. So what we do is we give it for a given year. So this, you will see it in the case study. So for every year, we could track how much was the gross margins, how much was the operating margin, what was the net profit margins, etc., etc. So you have different ratios. So the first thing you need to do is, of course, understand these ratios. Then you and your team need to decide which are the ratios that for you are the most important one. And this is what we do in the balance scorecard. We don't take all these ratios. We might take 3, 4, or 5 of them maximum, and we say these are the ratios that for us are the most relevant, and these are the ratios that we're going to track. So this is, and not only are we going to track them, we're going to review them, either on a monthly basis or quarterly basis, which is what we have been doing with a number of you. But not only are we going to define them and we're going to track them, we will also going to be able to compensate the team, the leadership team, based on how well we are doing on a few of these ratios. And this is what we normally do with the compensation of CEO. It's not only done on a typical bonus, but we could have this bonus would be linked to how good is the organization in delivering on these key ratios. And these key ratios typically will be operating profits, but they also could be revenue growth, or it could be others, depending again on the board, depending on the situation that the company is facing. So these ratios allow us to monitor the situation, to see how we have been over the past years, how we are compared to benchmark, make it transparent across all the people that are joining these quarterly reviews, because you see how these companies, the different companies within the group are doing, but also to help define what should be the compensation, not only short term, i.e. for the year, but also long term. So we just, for instance, in one of the groups that we have been working with, we hired the group CEO. We agreed with the group CEO his compensation scheme over the next 5 years. So what are we going to do? And these are typically stocks or equity that we're giving in the organization based on what? Based on key ratios that as a board we decided these are the most important ones. And the compensation that the CEO is getting from those stocks is actually higher than his annual compensation. So this is how it works. It works in having those ratios, identifying them, tracking them, making them visible to the whole organization, and at the same time, of course, taking actions on whatever gaps we're facing, but at the same time compensating key players in the market. Next slide, please. So if you have any questions on those ratios, feel free to reach out. You don't need to reach out to us. You should reach out to your finance person. If you don't have a finance person, you could reach out to us. So this is so these are some others based on activity, i.e. efficiency. Typically it's receivables, but it could be also inventory. So those of you who carry inventory. And at the end, it's the cash conversion cycle. Is how long does it take in order for you to be able, from the moment that you are generating your revenue to the moment that you're collecting the money, to the moment that you're paying your suppliers, what is this? And the smaller is this figure in terms of cash conversion cycle, the more efficient you are. So and this is where your cash is. Your cash is either in the pockets of your customer, or it's in the pocket or in your inventory, or it's in the pocket of your suppliers. And your role as finance or as CEO is to be able to manage this cash efficiently so as to release the cash that you need to run your operations. Okay, next slide, please. Now, this is a long list. As I said, you will choose, or the CEO of the organization chooses these ratios. Liquidity are important. Current ratio, looking at current assets versus current liability, that should be more than one. The asset test is you remove inventory if you have inventory, because inventory might take a long time to be able to be turned into cash. And then you have sales to working capital. Next slide, please. So this is liquidity. The gearing are regarding the leverage, how much debt you carry. For those who are carrying debt, typically we use debt to equity, but we also could use other means to be able to measure how much debt you're carrying on your balance sheet versus your ability to finance this debt. Next slide, please. Investment ratios. If I'm an investor, what I look for is I look at the return. And one of the return is return on invested capital. This is or return on net assets. They're the same. So this measures how much profitability you are generating in a given year versus the capital. And your capital is two ways: is your debt capital and your equity capital. So you could measure it with equity alone, or you could look at debt and equity capital. And normally when you have this return on invested capital, you compare it to what? You compare it to your cost of capital. Every single one of you as an organization have a cost of capital, which is your cost of debt and your cost of equity. For those who carry zero debt, it's your cost of equity. And we have clear milestone benchmark by sector in terms of what is the normal return on equity or return weighted average cost of capital across different organizations by size and by sector, so that we know what is the weighted average cost of capital. So if we know what is the weighted average cost of capital, i.e. the actual cost of capital for your organization, and we know what is your return on invested capital, the difference between the two multiplied by your capital, debt plus equity, gives you the value that you have created in your organization. So this is a very simple way of measuring value creation or value destruction that took place in an organization. Now, I know that for some of you, it's a bit Chinese. It doesn't matter. With time, you'll understand it, because these are typical discussion items that we have in boards. Because are we creating value? This is the fundamental question. Is this organization creating financial value, or is this organization destroying value? How do we measure it? We measure it by looking at your return on invested capital, and we measure it by looking at your cost of capital and deciding whether we are creating or we're destroying value. And in case we're destroying value, where is this value destruction taking place? So we look at it by services or by products. We look at it by entity, and we decide, which are the entities that have a very high value creation with low risk associated with them, because you always have to look at the risk factor. And these are the organizations where we want to invest. And which are the ones that are destroying value, where they have a low or a negative return on invested capital on it, and they still have high risk behind it. Why do we keep them? Or how can we help address the challenges that they're facing so that they could restore and move to financial value creation scheme? And this is what we call portfolio management. And this is one of the fundamental responsibilities of a board, is to decide where is value created, where is value destroyed, and for those where you have value creation, what can we do to help them even grow faster? And for those where we had destruction of value, what we can do to help them? And in case we don't help them, at one point in time, we either sell it or we close the organization. The same thing that applies to organization applies also to countries, and could apply because some of you are present in different countries, but it also could apply to products. You have launched a product, you have a bunch of products, and some of these products or services are very profitable, others are less profitable. So that we have, and so we go through the same exercise, not only for operating companies, but we also look at it from the product or service category. We could also look at it from a customer. With some customers, we're creating a lot of value for the organization. With other customers, we're not. It's important. But some we decide, no, we want to keep them, even though the value creation is low, because these are strategic customers. But this discussion needs to take place. So you need to understand where is value created, and you need to understand where is value destroyed across products, across services, across operations, across countries, across customers that you have. And the better you have an understanding, we call it the profit pools. Where is profit being generated? Where is profit not being generated? And we put it all together. So it gives us an understanding afterwards to decide where we want to invest and where we want to divest. Okay, next slide, please. So this is the real life case. Now, this real life case, yes, go ahead.
Hi, Dr. Bala here, Constantin.
Hi, Dr. Bala. Always a pleasure.
Thank you. Can I quickly ask a question here?
Of course, of course.
Right. Can you please explain, the fundamental difference between capital employed and invested capital and incremental capital?
Okay, look, I'm going to keep it easy, Dr. Bala, at this stage, given the size of the audience. What I think is most important is that all organizations need to raise capital. And to make it simple, this capital is either debt, because you go to banks and you raise debt, and a number of the organizations have raised debt, or it could be equity capital. So this is capital injected by existing shareholders, potentially by new shareholders. So this is what I define as invested capital. So it's either debt or it's equity. And this is very simple to measure, because on your balance sheet, at a given point in time, and typically we look at the end of the year, we know what is the debt position of the company. We know what was the debt position last year, exactly a year ago. And we know also what is the shareholder equity, and we know what it was a year ago. So this is so these two are the simplest one to track. Now, return on capital employed is what? If you look at your invested capital, which is on the right side of the balance sheet, what do they use? Primarily, they're here to fund your working capital. So the working capital that you have is your receivables, your inventory that you get, minus your payable that you have. This is the working capital. So you will see that your invested capital goes on either funding your working capital, or it goes into funding fixed assets. For those of you who have fixed assets, it could be building, but in most of the cases, we tend to focus on the working capital. So at this stage, when you look at return on invested capital, you look at the right side of the balance sheet, i.e. you look at debt and you look at equity. But what are these debts and equity used? They used to fund what? Your capital employed. And what is capital employed is typically your working capital, and in some of the cases will be your fixed assets. In your case, it is because you carry no inventory, you have very little fixed assets that you have. So you're in a situation where, and you have, of course, no debt. So you're in a situation where basically equity is the key element in your balance sheet. You might have a few receivables, but it's very marginal. But it would differ across the different companies. You're about 110 people on this call today. If I look at it, you have different companies, different organizations that have different challenges. Okay, so I want to keep it at this stage. Thank you for asking the question. Any other questions before we move to the case study?
Thank you.
I know that it's a bit Chinese, what I've covered, but if you have questions, please ask the questions. Don't be, I mean, there are no, all questions are good questions to have. So this is a real life. This is a real life situation. This is a company that has been operating. We have here their ratios from 2019, 2023. We have also added a benchmark. And we'll share with you how we go about defining the benchmark. And this benchmark that is applicable to this company might not be applicable to you. So what we do is, depending on the company, depending on your sector, depending where you are you in a scale-up phase, are you in a mature phase, these benchmarks will be different. But we can help you build those benchmarks. And these benchmarks are essential because it shows you what is the average ratio that you have for organization in your sector and in your geography. Because if you are in East Africa or you're into the Middle East, it might be different ratios than if you are in North America, in Europe, or in Asia. So the sector is important, the state at which the company is in terms of its growth state, and its geographical position will end up affecting what the benchmark is. But my message here, it's important not only that we track historically, but we also come up with what we believe are the right benchmark for this organization. Now, the board of the organization might decide this is the industry average, but we want to be in the top quartile. We don't want to be in the industry average. So the board might decide to set benchmark that are different from the industry average. So this is important for you to note. And we, for instance, these benchmark here in some ways have been set by the group CFO with the CEO, group CEO, and myself. We decided what should be those benchmarks. And we might decide to change a benchmark from one year to the other, but we always take into consideration what is the industry doing. Then afterwards, it's up to us to decide in this category, we want to be in the top quartile. Top quartile, we want to be in the best. In other category, we have no problem being average. And in another category, we might be below the average. So this is important, and very few companies are doing it. Very few companies are tracking these financial ratios, and very few companies are using benchmark to see where they stand. So this is profitability. You've gone through it. We have revenue, gross profit, operating profit, net profit. Revenue growth is important. It shows you how much the company has been growing. And like a number of these companies, they've been hit by COVID in 2020 and in 2021. And they're recovering from COVID. But if you look at how much reduction in revenue they had in 2020, it's still a challenge to come back to the pre-COVID levels. And this is the place for a number of your company. Not all of you. Some of you have managed to go through this wave and do it quite beautifully. So these are the profitability ratios that includes the profitability regarding to the income statement, but it also includes profitability as return on invested capital, which is fundamental. This is the one I've measured because this is the one that helps us decide what should be the value that is being created by the organization versus the cost of capital. You have leverage ratios, how much debt to equity. Let's use the debt to equity as to be the one that to keep the story simple. And you see how this has evolved. Next slide, please, Lama. Liquidity. How liquid is this organization? Remember the benchmark. Here we've put a benchmark. We look at current ratios to make it simple for all of you. So we want the current assets, which is basically your cash, your receivables, your inventory, to be higher than your current liability, which is typically short-term debt and accounts payable with your suppliers. We look at cash conversion, which is a measure of efficiency, by looking at your inventory turnover, your receivable turnover, your payable turnover, deciding, and your cash conversion cycle. So how much, and cash conversion cycle is a good summary of it. Then we look at solvency, your ability to finance your debt. In this case, we'll keep it with your interest covered. So the interest covers is basically what is the ratio of your operating profit versus how much annual interest expenses you're doing. And normally and this is an important, actually all important ratios. And by the way, when we define what is Kenya or what is Lebanon or what is France or what is Switzerland, credit rating, these are the ratios. But for a country, you might include 2 or 3 other ratios, but the process is exactly the same. So if we decide that Switzerland kept its AAA rating and France have downgraded their rating from AA to AA minus, this downgrading has an implication on the cost of borrowing. It means that the organization is a bit less sexy financially than it used to be. It means that there is a bit more risk, and then the cost of debt will increase. This is why Minister of Finance in all countries are extremely keen to protect their credit rating because it lowers their cost of borrowing. And the best is your credit rating, the best is your cost of borrowing. And this is why it becomes quite important to have. Now, very few countries are AAA, even AA plus, most of these, depending on these companies. Now, some companies like some countries, like what we have in Lebanon, we defaulted. So we're not anymore A, B, or C, we're D for default. This is when the country did not meet its financial obligation, and it's a default situation, which is of course the worst that a country could be. And the same logic applies to companies, and the same logic applies to you. So if Dr. Bala is going to the bank is going to ask him a few questions on his wife, trying to see what assets they have, what income they have. Why do they ask all these questions? Is because they come up with their ratios, and based on these ratios, they decide how much debt can Dr. Bala borrow, and at which condition do we lend him, i.e., what sort of credit rating he has or the family has, based on the assets and based on his income. So this exercise is done at the country, is done at the company, is done at an individual level. So this is next slide, please, Lama. So we have liquidity, we have cash conversion. Okay, go back to the first one, to the one. Okay, so now you have these are the ratios. Now you've looked at these ratios. So let's focus on profitability. The questions here, I'm going to ask the questions, Lama. So go back to we could show the slides. Thank you. Okay, so my question to all of you, those who have read, it's very easy to read. It's a table on it, and it shows you the importance of financial ratios. So what are the conclusions that you have? You sit on the board of this company. The CFO, Raj equivalent, I'm sorry, Raj equivalent is coming and presenting to the board. These are the ratios. This is what we have done over the past 5 years because the board have asked. Normally, Raj would say, I will show you the results of this year, 2024. I will show you the results of this year compared to last year, 2023, and I will show you the budget that we have agreed for 2024. So when Raj or others are coming and presenting, they will say 3 columns. They will say actual results versus last year versus budget. And this is normally we always go and look at this. Not only actual results, we want to see versus last year, and we want to see versus budget. Now the board have asked, we want to see this happening over the past 5 years. So to see how we're doing. And so this exercise has been done in this company upon the request of the board to come up. So now you're sitting, you're the board. What are your, let's focus now on profitability and leverage. What are the conclusions that you have, or what are the assessments that you could do of this organization? And what are your recommendations in terms of what needs to be done? So 2 things. What is working and what is not working in this organization based on these ratios? and what should the organization do in order to address what is not working. So just unmute yourself. I'm going to see there are questions. Is having trouble joining in the train. Okay, fine. So we have, so please unmute or raise your hand and we on it. So this is the case. You're on the board. Alan, you started. Go ahead. Good morning, Alan.
Good morning, Constantin. How are you?
Good. You know, I'm always pleased that it's the head of IT that is going to comment on the financial ratios. This is wonderful. So it shows you how important it is across function. When Catherine is going to raise her hand as head of HR and being able to do this, I'll be even happier. But go ahead, Alan. So what is your first assessment?
First assessment, I'm noticing that the return on invested capital is very low. The benchmark is 17%. We've never over the years gotten to of anything over 10%. That's the first thing that I know.
Excellent. Alan, I'm going to stop at this point. We're going to give you but you've pinpointed a very important point. The important point is that historically the return on invested capital, which is basically your operating profit divided by debt plus equity, has been consistently between 1.7% to 8.9%. So let's say on average, around 4 to 5%. And the benchmark is 17. Now, what is the benchmark? The benchmark is basically the weighted average cost of capital. For this particular organization, it's cost of debt plus cost of equity that is weighted average depending on how much debt and how much equity. So what it means that the company has consistently destroyed financial value because every single year they were not able to meet the benchmark. So there have been financial value erosion, although the company has been profitable. If you look at if you look at net profit or operating profit, which is the most, it has been 7.8, 11.8, 7.9. So this has been profitable. So you could be profitable, but at the same time, you could destroy value. So in this case, it's a great point, Alan. This organization, although profitable, has destroyed value every single year from 2019. And this is a huge issue for this organization. So Alan, I know you have other comments, but for instance, in this, now this is an important, and I fully agree with you. What will be your message to the CEO and to the leadership team? Alan, go ahead. Go ahead.
All right. Well, the message probably we need to reevaluate why this is happening and adopt corrective measures. Because primarily, actually, if you look even in December 2022, that is when it was very, very bad.
Okay, so this is good, but it's not enough. You see, if you're not specific, it's, for instance, Shital was presenting these numbers. If you tell them you need to improve the numbers or only, Shital will tell you, okay, I'll improve. But in some ways, I want you to be a bit more specific, and I'm going to help you. This is done by two things. You have to look at what is in it's the operating profit divided by debt plus equity capital. If you look at the operating profit has been low. And why it has been low? One is because your gross profit, if you look at 2020, the gross profit has been 37%. It declined systematically to 33%. It means what? It means that the company is facing either increased competition, so they have to underprice, and this is what could happen with EHS and MIC. Once you lose your exclusivity, I will tell you, you're going to have a hit on your gross profit margin, which today are high. But you will be affected because you're going to have other players that you'll be competing with that you necessarily didn't have in the past. So in this case, part of it is what can we do in order, so if we look at Shital, if she was the CEO, we say, Shital, your gross profit margin has been declining over time. So this means that you're becoming more of a commodity product. We want you to differentiate yourself versus others so as to restore the profit margin. We've put 35%, we were kind, but normally the benchmark should be in this industry probably 37% that we had. But we didn't want to, so on this. So this means what? It's Shital's responsibility to work with the team and to come up with either new products or new services that have higher gross profit margin. And this is, you will see, this is one of the recommendations that comes in. So this is one is your gross profit. So your gross profit has been declining. The second one is your operating profit. Your operating profit actually declined even more. It means what? It means if you look at your operating cost to income ratio, income means to revenue ratio, your income, you were at 63%, i.e. your total expenses were 63% of your revenue, and you went up from 63% to 89%. Unacceptable. Unacceptable. You have been building up your expense structure by either paying more salaries or hiring more people when your gross profit margin has been declining. The combination of the two, decline of gross profit with increase in your operating cost to income ratio, is resulting into a deterioration of your return on invested capital. So what Alan has said is your return on invested capital is low, lower than the benchmark. Every single year, you've been destroying value. What we have added to it, it comes from gross profit. And here the mitigation action is come up with new products and services that will help you address it. But it comes all from your operating expenses. You have been growing your operating expenses much faster than your revenue. And this is not acceptable. So when we're going to issue budget guidelines, we will take into consideration this. We will put under the budget guidelines, this is the gross profit that we want you for 2024 or 2025. And this is what sort of operating expense to revenue ratio we're going to put in, so as to reverse this trend that has been unacceptable from gross profit or from an operating cost to income ratio. So by just focusing on this category, Alan has pinpointed on one of the weaknesses, and we helped him come up with recommendations. Any other feedback? Not Alan now. I want somebody else. Andre, go ahead.
So I noticed that while the ROIC has been decreasing, the leveraging has also been decreasing, even though the cost of debt is actually not that high compared to the benchmark. So I think what the company has been doing was getting the invested capital to pay off cheap debt, while it should have been using it to maybe grow the sales, grow the company. And I think maybe, and this is an assumption on my part, that because the operating cost to income ratio has become very high, that they're maybe getting behind on maintenance on some key aspects that have been increasing their operating cost. So maybe they have been neglecting some things to pay off the debt, or maybe they've been hiring more people, like you said.
Okay, Andre, good. So look, operating expenses typically will be, the bulk will be salaries, but it also could be electricity. Like for instance, in Lebanon, because there is no more public utility, so it's basically the cost is coming from mazout generated or diesel generated generators that are producing, and they're producing at 60 or 70 cents per kilowatt hour, which is extremely expensive. I'm in Switzerland here. Now I'm telling you, I'm under the roof. On top of me, I have solar. And this solar, when I'm not here or we're not here, goes directly to the grids, and I end up being paid for the electricity that I generate. So the cost of electricity could be one, utilities could be one, but you're right, it could be maintenance. If you have a fleet of cars, it could be maintenance on it, or it could be salaries, or it could be other expenses that we have to look at. But your point, I want to take it, is important. If you look at the positive side, and the reason why they decided to deleverage is because we as a board, the company was operating in an environment. Now the cost of debt has been low. It has been low because the governments were trying to induce but the cost of debt today is actually getting higher. So if depending where you are. So for instance, in Lebanon today, if you want to borrow money, but even in Kenya, if you want to borrow money, you will borrow money at 12%. You might even have to borrow money at 15%. So this becomes pretty high. It is not reflected in their actual cost of debt here, but the real cost of debt that you have in these two countries, but in other countries, emerging countries, is also high. So what we as a board said, we want to deleverage. So we want you to take some of the profit that we're making and reduce the debt structure. And if you look at the debt to equity, it moved from total debt to equity at 2.62 in 2019, and it went down to 0.81. So basically, we have more equity than we have debt. We're in a good financial situation. So there has been an attempt, not an attempt, a drive to deleverage the organization. And why? Because we were afraid that in an environment like we are today in Kenya or in Lebanon, but we could say, I mean, you have people from other countries on this board, the cost of debt actually is high. It is high in emerging economies. It is high in emerging economies where you have volatility, like what you had in Kenya, like what you had in Lebanon, like what you have in Egypt, like what you have in Jordan, in a number of the emerging economies in sub-Saharan Africa, but also in North Africa and the Middle East. The cost of debt have been high, and in some cases have been extremely high, to the point where there is no more debt being issued. In Lebanon, very, very seldomly would you have debt because all the banks stopped issuing debt. They stopped issuing debt completely. So the debt is coming from either business angels like ourselves, like CS Touch. We have been investing. Last week, I signed a term sheet for $500,000 for one of the companies. It was a debt term sheet. So this was a debt term sheet, but the interest rates were even higher than the benchmark that we have. But it reflects the risk that we have in the country. So one message behind it is, yes, your leverage has went down. And the message went down because of this fear that the cost of debt might increase and might affect our cash flow. Go to the next slide. I'm going to show you to continue on this. So we have the next slide. Not only the debt was leveraged, if you look at the receivables and you will see an inventory, you will see that the inventory in 2020 was 323 days, i.e. they were carrying inventory equivalent to roughly about 11 months of operation. And this went down to 181. This is where the cash was. The cash was into the inventory and the cash was in the receivable. Their receivables were at 248 days and it went down to 117 days. So not only they deleveraged, but we told them you need the cash to deleverage. And we don't have cash because the operation has not been as profitable as we would like it to be. So what they've done is they reduced the inventory and they reduced the receivable. And with the cash released, they went in and reduced the debt. So by getting down, so they made the organization more efficient. In terms of inventory, they made it more efficient in terms of receivable on it. So their financing gap was at 280, ended up at 179, which is still high. We need to bring it down, and this is why we've put the benchmark at 155 in this particular case. But in a number of cases, it could be even below 100 days. So there are some positives. It's not only, so from the leveraging side, they reduced the leverage, they reduced the debt. From the efficiency side, they reduced the receivable, they reduced the inventory that they have. So they are much more efficient as an organization, what they need to do. Okay, so thank you, Andre. Any other feedback? Anybody wants to raise their hand and comment? Good morning. We're 115 people and no single feedback. I put the picture. So this is put back the picture. So maybe it gives them some creative thoughts. Go put your screensaver, Lama, on.
What picture?
You had the. So this will be the incentive for the budget approval. This is the village close to anyway. So it's so this is the view when we go hiking on it. So it gives you some creative cells on it. Lama, go back to the okay. Any other comments? You showed those two slides on the profitability. on the efficiency, on the liquidity, on the cash conversion, on the solvency? Any other comments from this organization? Come on. It's important. No, Andre, you've been kind enough. I want other people to speak. Other comments? I'm disappointed. And when I'm disappointed, I share it. I expect every single one of you to have a comment. If you don't have a comment, you should not be on this call. So it's you're here. You should have read this case study. You've seen the case study. You have some obvious. You're still digesting. So is it? So Bianca is still digesting the info. I know that for some of you the info might be high. So what other comments you have on this? You sit on the board. You've asked as a board the CFO to present. You know, some of the finance team. I'm expecting some of the finance team to ask and to give comments. I'm expecting the CEO of the businesses to give comments.
I'll show the questions. Maybe from the questions, people will be inspired.
Lama is always very kind. The question is, what is the overall assessment of the financial health of the company? How has the company scaled over time? You should be able to answer this question. How attractive is the business model? We answered part of it. How efficient has the company been? What is the biggest challenge that the company is facing to improve profitability? This one we addressed with the operating expense and the gross profit. How has the company managed its capital structure? I mean, how much debt versus how much equity over time? How well can the company service its debt? How is the company managing its cash flow? And what are the short-term actions that the company needs to implement? The short-term actions is typically what the board will discuss and come up.
So let's try to answer the second question about scalability. I'll show the growth and revenues again, and please feel free to unmute and give us your input on the growth and sales or in revenues that has been witnessed since 2019.
I will not move forward on the slides unless I have feedback.
If I can try, Constantin.
Thank you, Dr.
Bala
Bala.
here. Sure. Certainly, debt is a concern. Debt is always risky, even for healthy companies. So they should definitely take care of, a lot of care of the debt. Number two, the operating margin seems to be very, very poor over last, several quarters, several years. They need to definitely, do a lot, focus all their energy and strategy on raising the operating margin, which in turn, means they should, sell a lot more. Their sales have been going down with respect to their, assets and debt quite badly.
Very good. Dr. Bala, thank you. I think you've summarized it. So on the scalability, you will see that there was a dip in 20 and 21. There is a dip. And the growth rate that came up in 22 and 23 is still marginal compared to the severe drop in revenue that took place in 20 and 21. So a big focus of the board is saying that, okay, we have reduced our debt. We have now the room to be able to raise more debt, and we have the ability to also to raise equity capital. We want you as an organization to tell us where are the growth opportunities. We want to grow the organization and regain the market position that we had in 2019 before the COVID crisis. So a big issue here in terms of scalability is that the revenue growth has been also below par. And this is one of the guidelines that you will receive when we do for EHS and MIC the budget, is we're setting what are those revenue targets, growth target that we expect. So not only your expense structure is too big, you have not grown the organization as fast as you would. So we will focus 2024 and 2025 on asking you to come up with growth opportunities, either new services, or it could be partnerships, or it could be new countries that we want to operate, that we could do, or it could be new company that we want to set up. But we're here, and you as the operating companies, CEOs of these operating companies, come up with your recommendation, how can we grow? And what can we do in terms of either acquisitions or partnerships or new products or new services in order to be able to restore the growth momentum that we had? Okay, so this is important. Thank you, Dr. Bala. So to summarize it, growth has been an issue, and the message from the board is show me where we can grow, and we will make sure that you have the funds to be able to grow. And this is the work that Lama and I are doing with a number of the companies that we're working, is to be able to help them identify the growth opportunities that they will have next year or the following year, understanding what sort of investment is needed, and helping them raise this investment, either in terms of debt or in terms of equity. In this case, since the debt has gone down, so there is now room for more debt, but we want to do it on selective opportunities that are growth opportunities. For the gross profit margins, the message was clear. We want you to be able to come up with services or products that have higher gross profit. So this is an important. So all of those recommendations will end up being priorities, what we define as key strategic initiative for the following year. So this is on the operating cost. We cannot allow you to grow your expense structure higher than you grow your gross profit. We cannot, or your operating profit. So this will also be a guideline. So you need to optimize your cost structure. And the more you grow your revenue, the more you'll be able to invest in your operating expenses. So this was also part of the discussion that we had. And part of the way to become more efficient could be on automation or could be on other ways to do it. The debt, we covered the debt. Good job on the debt, bringing it down. On the liquidity, the company is liquid. Normally the benchmark is 1. Here we've put 1.5. Actually, they've improved it from 1.2 to 1.96, means that the company has high current assets that allows them to fund it. From the cash conversion, they've been more efficient, but there is still room to grow in terms of the efficiency so as to release more cash that can be used in order to fund the growth opportunities. On the solvency side, the interest coverage, we're looking at it. So we still have room to improve on the interest coverage, especially if the cost of debt is high. We need to maybe, if not debt, we need to look at equity partner. So we need to look at strategic partner. And I know that a number of you are doing this. So you are looking at strategic partner. You don't want to have more debt. You want to have a partner that can add value. And this partner will help you by investing in it to help you to improve the interest coverage, because you will be able to either reduce your debt in case the cost of debt is increasing. So this is a bit of a summary of this case study. So I want you to digest it. And I want you, when you start looking at financial statements, to start thinking of ratios. And these ratios give you a good indication of the state of the company, a good indication of what is working versus what is not working, and a good indication of what needs to be done. And this is important. And ultimately, what we want when we set up the ratios for 2025, this is what we'll be doing during your budgeting process. And all of you will have a budget for 2025. We'll take into consideration what has happened over the past years and what we would like these ratios to be in the years for next year, for 2025. Actually, with Shital and with Ali, we came up with this over the next 3 to 4 years, and come up with what, and we've summarized some of the key figures that will be impacting the value creation potential of the organization. Okay, I'm going to stop here. Any questions on this case study? No questions. What an audience. Okay, so we're going to move to the balance scorecard. If you have questions, feel free to add it to the chat. The balanced scorecard, I'm not going to spend a lot of time because most of you are familiar with it, but it's a great link because what the balanced scorecard does, it looks at the key stakeholders, shareholders, and this is what financial excellence is all about, customers, because you're here to address a pain point that customers are facing, operational excellence, how efficient are you, and how good are you in attracting and retaining and developing your talents. So these are your four key constituencies: shareholders, customers, your partners that you have under operational excellence, or the tools that you have, automation and others, or working capital management, and then, of course, your employees. So what the balanced scorecard does, and this is what we do at the beginning of each assignments that we have with the companies, is it's a roadmap. It's a roadmap typically for a year. What are we going to focus on over the next 12 months? So what are the key projects that we want to implement? And what are the key measures of success to see that we are doing well as an organization? Once we do this roadmap, for us, it's very important because it gets us to know the organization and for the organization to get to know us. But at the same time, it helps us decide which are the areas where we could add value. So this roadmap is actually KYC, if you want to know your customer approach, but also it's a way for us to understand where can we add value to the organization. So when we sat down, I'm using again Shital and Ali when we were in London last month, we actually developed the balanced scorecard for the next 12 months, and we will share it with you. We have defined what are the key strategic initiatives that we want to implement. We have defined who owns it, and we have defined the timing. Shital, by the way, you still owe us revised timing on these balanced scorecards so that we could finalize the set. So it was supposed to be last week. So, and I know that Ali has been traveling, but this is, Lama will come back to you on it. So this is what the balanced scorecard is all about. It's about defining the roadmap. And this roadmap allows us, one, to understand what needs to be done and allow us to understand how do we measure that we have been successful or not. Next slide, please, Lama. So, and this is a typical one. So you have your 4 dimensions. You have on one side the key performance indicators, and these indicators are what are coming from your financial statements. So they are coming, or your financial ratios. So the typical one for shareholders, they look at revenue, gross profit, operating profit. They might look at cash flow, and they might look at some of other ratios, return on invested capital. From the customer perspective, it's about revenue growth. It's about market share, if you could measure it, but it's also in terms of incremental number of new customers, new partners. It's also, of course, on customer satisfaction, either the index or what we call today the Net Promoter Score, NPS. So this is a combination of satisfaction, retention, and referral that you have. So these are measures. These are measures that we set. So for 2024, EHS Kenya wants to grow by 12%. So this becomes a measure. So the revenue growth for EHS Kenya is 12%. The market share, either you track it, if you don't track it, we look at revenue growth. So these are key performance indicators that are coming primarily from your financial statements or from information that you have access to. The operational excellence is on efficiency. Claims, for instance, turnaround time is very important. And you have others that you could get. Productivity by headcount. It could be working capital. It could be, we mentioned receivables, we mentioned payables, we mentioned inventory. And for the employee, how good are you in retaining your people? How happy are your people? What is the percentage of employee that are happy? And if they're not happy, what are the key dissatisfiers and what can we do to address it? It's typically related to either communication, training and development, opportunities that you have to grow, treating the employee with respect or whatever. So but they will tell you. They will tell you what is working and they will tell you what is not working. And this is an important measure because if employees are not happy, what happens? They vote with what? They vote with their feet. They leave the organization. So this is why we measure talent retention rate. So out of these top talents, what percentage of these top talents are we losing? And this is a huge issue. If this is a big figure, there's something fundamentally wrong in the organization that needs to be fixed. So it's equally important as revenue or gross profit. Because really, revenue, gross profit, and operating profit, if you have happy customers, if you have happy employees, and you have an efficient organization, these numbers should look good. So we don't only focus on the financial aspects, you also look at employee engagement, and you look at customer satisfaction level and loyalty. So this is the measures of performance. And you then decide what are the 2 or 3 measures are the most important one. And then on the strategic initiative, what are those breakthrough projects, not business as usual, breakthrough project that you will put in place? Take the example of, for instance, EHS. So one of the EHS, one of the things that we want to do is we want to launch a new set of, let's say, products or services. So we want to launch it, we have to develop it. We have to make sure people are trained on it. We want to make sure that we have the right automation tool behind it. This becomes a breakthrough initiative. So this is the example. We want maybe to open a new country. So this becomes another breakthrough initiative on the customer excellence. So if we want to set up, a new country or expand into a country. So this is new locations, is typical examples of a breakthrough. This is a project that takes time, that takes resources on it. On the operational side, it could be you have Navision, or it could be another ERP platform that you want to put in place, or it could be your credit and collection policy that you want to enforce because you have issues with receivable. It could be different examples. But these become projects that have clarity in terms of ownership, clarity in terms of time. A project has a certain time. It could be 3 months, it could be 6 months. It has an owner behind, and it has an impact that it would be generating. So what you do here is you list those key projects and you list those performance measures, and we review them on a quarterly basis as we have done. I don't want to spend too much time on it. On the people side, it's typically about hiring top talents. We will be hiring, but it's also about training and development. It's also about recognition. It's also about we want to put in place, I don't know, a special insurance program, or we want to put together a special retention program. Next slide, please, Lama. This is an example of one organization.
Sorry, Constantin, I have a question going back to finance.
Yes.
For example, the bank scorecard, when we go through it, and there are certain recommendations that you make.
Yes.
What action is then taken to implement those recommendations? Just to give you an example, several times you have told the finance team that when they see that, certain things are being overexpended, there's too much expenditure, is going over budget, it is up to them to, to put those things in place. So to stop, for example, if travel, if the budget has way, if expenses have gone way beyond budget already, they are supposed to tell whoever is spending that money to control, how to bring those controls about. So how is management planning to empower the finance people to be able to implement these recommendations?
Very good. This is a point that has been echoed by the finance team. Shital and Ali are aware of it. And it's a great point. And the answer is a very easy one. And this is something that we need to do. And Shital, this is for you or Shaheen to take we need to monitor the actions that we have recommended. And we need to see in the next board meeting which of those, this is what we call matters arising. So these matter arising, these are the matters that have been raised. And we want to make sure that whoever are the owners are implementing it. So it's critical that we have for every one of these reviews, we have a list of what are the actions or decisions that we have taken and make sure that these decisions have been implemented. And this, you're absolutely right, Gita, has not been implemented. So this is something that we have, and Shital, it is your responsibility to make sure that for every single one of these reviews, we have matters arising. And the first thing we do in the previous quarterly review is we review those and decide, are we on track or are we behind track? So great point, Gita.
So what we've done,
yes.
So what we've done, Constantine, is I'm actually waiting for the minutes from the HR team. Once we have the minutes, Shaheen has already come up with all the challenges so far since last year. So we've got 6 quarters of challenges, and we've removed the most common ones and kept them. And we actually have a meeting next week to just go through those. But in terms of the action, we will make a separate, like matters arising as soon as we start the next session, so that they are handled.
Excellent.
So
So
we're moving
Shital, this is
towards
good.
it.
So Gita, the point here is that for each one of these meetings, we might have 3 or 4 points, and the point on finance is a clear one. For instance, we want to make sure that we have consistency in the way we report. So this is, I remember one of the recommendation I've said is I've told Raj and I've told, I forgot who, Selim or I forgot the names that we have. But what we want is you have different way of reporting. We want to have a standard way of reporting. So, and we don't want to have too much text. We want to have bullet points that summarizes, and not only summarizes what is happening or what was the issues, but also come up with a more proactive way with recommendation of what needs to be done to be able to fix it. Say, for instance, if we have very high operating expenses, how can we do to bring it back to budgets? Or if we have very low revenue versus target, what can we do to improve on it? So this is a recommendation that we have set. We would list those moving forward, and we would review those to ensure that they have been implemented. So great point. Thank you for bringing it up, Gita, and Shital, thank you for your answer on this one. So this is great. Any other questions? Next slide, please, Lama. And by the way, the results for 2024 have been outstanding. So as you have been communicated, you've looked at what you've done, and I think it's a cause to celebrate when we are together in Mombasa, because you and the team in a very difficult year, because there have been a lot of transition, a lot of changes in terms of the partners that we've been working with, and a lot of attempt to get new partner on board. You've done an outstanding job in delivering strong growth, delivering strong profitability on this. So it has been so when we look back at the balance scorecard, most of it is a sea of green. There are a couple of exceptions that we have highlighted, but I'm sure these will be addressed. Okay, so this is an example of a balance scorecard. This was one of the leading social enterprise in Lebanon. They're here. So what we do is we didn't put the revenue and gross profit, operating profit, cash flow from operation. But this gives you an idea. And then what we do is we sit down with them, we review them. And this is presented the same way you're doing it at the board on a quarterly basis. And we review the key strategic initiative, we review the key performance indicators, and we try to see how we could help the organization address the red flags that they have in some of these projects or some of these indicators. Okay, and this for us is great, because for us, when we look at it, we look at the key strategic initiative, we know which are the ones where we could help. So where we want, and then we go and we say, okay, we could help you on your equity capital fundraising. We could help you on doing the board assessment to see how good and value added is. We could help you in developing your bonus and commission scheme for your sales force. We could help you on your training program for top talents. So these will be for us, it's a roadmap, or where are the areas that we could help. So it's very beneficial to it. I'm not going to spend more time on it. Next slide, please, Lama. Okay, now this is a very easy way. So what you do is you report. Again, I don't want to spend time on this. You actually report what are the highlights, and this is what you do. So this is what has been working. These are the issues that you've been facing. And if there is any help that you need in your commentary, mention it, because it's your opportunity to bring back to the group CEO or to the chairman, this is areas where we need your help, either in terms of automation tool, in terms of more resources, in terms of special marketing funding, in terms of new services that you want. So this is an example here where you put the key progress highlight, and this is what I would expect when we're going to be together in Mombasa, is that you, as a head of business unit and head of function, these are the key achievements. These were the key challenges, and this is the support that we need. Just one slide. One slide. It's enough so that we review your business. And this will apply to Alan, would apply to Catherine. At the same time, it will apply to Gita or apply to the other business unit heads. and you have the time allocated for you to be able to do it. We will also do the same thing with the sales force to see how we could improve business development and the sales efforts. Next slide, please, Lama. Okay, so this is typically how Raj and the rest of the team presents. You typically look at your actual, you look at versus budget, and you normally look at also versus last year. Here we don't have last year, and then you might have some explanation behind it. So this is on the income statement. You will do the same thing. Typically, it's mostly the income statement, but you could, at the end of the year, do it for the balance sheet. For those of you who have inventory and receivable. Next slide, please, Lama. And this is how you report it. And this is how you have been reported for the past years. You show your indicators. Yellow, green, it's on track. Yellow, it's a bit off track. And red, it's very much off track. And then what are the strategic initiatives, and are these initiatives on track or off track? So this is how we've been reporting. So we know clearly for each of the businesses what is working, what is not working. And the good news is for 2024, most of you have been more on the green side. So this has been extremely strong performance across the different indicators that we had. The only one where we need to look at and make sure is to make sure that from a customer satisfaction as we are, and retention, as we are shifting or changing our business model to make sure that we could retain, and the same thing on the employee side, to listen to them and to address whatever concern there is, so as not to find ourselves with a high turnover rate for top talents. Next slide, please. Next slide. Okay, so at this stage, I'm going to stop. So Lama was supposed to take you through the 5-year financial forecast. The next session we'll go through it. So this is a very important element, because no organization is able to attract either debt or equity capital without identifying what the forecast is looking like. So this is what we ask when we sit down once a year. Don't only show me what is going to be your budget for 2025. Give me a sense of what you can do. If we have all the funds that you need, how can you grow? So give me an indication of where is your growth going to take place, not only for next year, but give me an indication of what it could be over a 3 or a 5-year period. And it's important to do this because it allows us to understand which are the organizations that have the strongest financial value creation potential, and to understand also what is the 1 or 2 growth initiative that could be implemented in terms of either new country or new product or new service or partnership that could help us get there. So it's important that we do this. And the training that we will have when we are in Mombasa is to go through the 5-year financial forecast, so as to ensure that you know how to put it together. So when we're not only presenting the budget, financial budget for 2025, and comparing it to what 2024 would look like, but we will also get a sense of where can growth take place in our separate organization. And this is what investors are. Investors are looking, if I'm going to give you the money, where is this money going to be spent? I don't want the money to be spent in paying dividend to shareholders. I don't want the money to be spent to pay back debt or interest rate. I want the money that I'm investing to be spent on growth opportunities that could accelerate your value creation potential or accelerate the impact that you're creating. It could be environment, social, or others impact that you have. Okay, so this will be the topic of the next session we'll have is on this. We're going to stop here. Any questions on what we have covered? So we covered why are financial ratios important? What are the different types of financial ratio? Show you one real life case of a financial ratio, and being able to extract from it what it means in terms of what is working versus what is not working, and what would be the recommendation for the board, from the board to the organization, to fix these different elements that are not working. And this is how board add value. They not only add value by approving a budget or approving audited financial statement, but the real value is coming up with specific initiatives that is helping the organization address whatever challenges they're facing. It could be liquidity, it could be growth, it could be others. Okay, any questions before we wrap up, before we close? No questions? All been patient? You could go back to your usual. Look, appreciate the time. I was expecting it to be a bit more interactive. Thank you for those who have interacted, Gita and others, Dr. Bala and others. I think it's important that we make it interactive. The more it's easier to have it interactive when we're face to face, and this is what we'll be doing across a number of sessions in 1 month down the road. I wish you a great end of the week. Lama, thank you again. Joanna, thank you for the logistics. Any request that you have that you want to share, Shaheen, in terms of other skill set that you want? I believe I focused on the one that we use when we're at the board, but there might be other skill set gap that you would like us to address. I've mentioned sales, I've mentioned culture, how to build this new culture as the organization is evolving. Risk, how do you do your risk management framework? We've done the exercise with a few of you a few years back. We need to redo it. So whatever other recommendation you have, by all means, feel free to go back to Shaheen, who is always very responsive to it. A great week to all of you. God bless, and look forward to seeing you in 1 month down the road. Thank you.
Thank you. Thank you, Constantine. Thank you, Lama.
Constantine.
Bye-bye.
Thank you. Bye, everyone.
Bye. Thank you.
Bye.
Bye. Thank you, Constantin. Lama.
Ahlan. Rasha. Lama, can you stay on the call with Joanna and we do a wrap up? Thank you.